And I think we are on the cusp of an acceleration of the financial or credit reset away from financialization or paper assets into hard assets. I don't believe having gold is the end all, but it's very important in this day and age where the system is teetering on the edge, the financial and monetary system. But eventually, it will be good to invest your money, real money, in, let's say, productive assets.
In this powerful analysis, market strategist Mario Innecco highlights a signal that history can't ignore the Dow-to-Gold ratio's death cross. This rare event, which has occurred only a few times in the last century, often marks the beginning of massive shifts in global wealth. It's a sign that the world is quietly moving away from financialization, the endless reliance on paper assets, and back toward hard, tangible value. He explains how this ratio now points to a major acceleration in the transition toward real assets like gold, silver, and commodities. Every time this pattern emerged in the past, it led to a great unwinding of debt and inflated valuations, resetting what investors thought was normal. The message is clear: the cycle is turning, and those holding real assets will come out on top. If you found this insight valuable, don't forget to like, share, and subscribe to the channel, your source for gold, silver, and the truth behind the global markets.
And I think we are on the cusp of an acceleration of the financial or credit reset away from financialization or paper assets into hard assets. This is what these ratios are telling me, and it's telling me that the place to be is gold, silver, and hard assets, i.e. commodities. So back to the Dow-Gold ratio. So yeah, a week or so ago, I spoke about the Dow-Gold ratio, how there was a death cross. And the death cross was in relationship to the 7-year moving average, which you can see here. And every time the Dow-Gold ratio, which basically is how many ounces of gold you need to buy one Dow Jones Industrial Average, yeah, it had crossed below that 7-year moving average. And every time, well, 3 other times in the last 100 years or so, that signal a great unwinding of a credit, the previous credit bubble. And as you can see by this chart, I said that I thought the last credit bubble started after the '08 crisis. And yes, the Dow-Gold ratio did rebound above that 7-year moving average, as you can see, back around 2012 or 2013. And it stayed there pretty much until recently, even though it dropped below that moving average back in 2020. We know what happened in 2020, of course. And then they came in and they threw even more funny money and borrowing into the system. And that's why the Dow rebounded above the moving average. But it's completely failed now. And the other thing that I noted the other day, because Friday, the last trading day before today, was the end of the month, and this is a monthly chart. You notice that we actually closed back below this trend line, which is really important. A few months ago, it closed below it, and then it rebounded above it, and now it's gone back below it. I think it shows that the trend is lower. And what does that mean? Well, it means that gold and silver, for that matter, don't forget silver, will outperform financial assets, i.e. Common stocks and government bonds and corporate bonds going forward. And I think we could accelerate a lot lower. This ratio can be quite sticky, but once it turns, it can move very quickly. It could be a matter of 18 months to 2 years, I would say here. It sounds a long time, but if you think in a matter of days and weeks, I think you're in the wrong game, investment game, or safeguarding your savings game. So Yeah, I'm still convinced we're going to see this ratio back down towards 1 or 2 to 1, or maybe even lower, because ever since the early 30s, when this ratio has bottomed, it has been at lower levels, and when it has topped, it has been at higher levels. There's like a megaphone formation. So yeah, very bullish, I think. But there is another ratio which is really important too, is the gold to S&P ratio. It's the same kind of thing, but we look at it in terms of gold instead of the S&P. And as you can see by this chart, another monthly chart, gold, you could buy 8 S&Ps almost with an ounce of gold back in 1980. And then gold bottomed in terms of the S&P. You could only buy 0.185 back in the early part of this century. And then gold rallied strongly up until 2011, and it's been basing ever since. Really, there's been a bear market in gold versus the S&P, but I think now it's turning. And the interesting thing is that in the last, I think it was back in April, it started taking off, gold to S&P, and then it came back down sharply, and it actually retested the breakout area, which is very positive technically. And now we're going back up, so we need to keep an eye on this. I think if we break through 0.7, that's very bullish, and that in of itself will also help the Dow-to-Gold ratio, because I think right now it's one of the reasons the Dow-Gold ratio hasn't dropped even more, is because gold to S&P is still not clear, but I think we're getting there. And at what levels will, let's say, the Dow-Gold ratio be if we go 1 to 1? It's difficult to say, of course, but it's all relative, right? You'll be able to buy a lot more financial assets when that happens. And yeah, I want to emphasize that I don't believe having gold is the end all, but it's very important in this day and age where the system is teetering on the edge, the financial and monetary system. But eventually, it will be good to invest your money, real money, in, let's say, productive assets. But I think we're not near there yet in terms of value. I think you can wait, and that's my opinion, when it gets to 1 to 1 for the S&P. I think there's still a lot of room as well. If we get to 8 S&Ps to 1, 8 S&Ps to 1 ounce of gold, that will be good too. It could go even higher. Let's check out gold first, as we always do. Spot gold is at 4,024, up 21 bucks. I noticed overnight, late last night here, London time, that gold dropped sharply on the open on COMEX and the futures. It dropped to 39.62. So it's quite encouraging that it's rebounding, especially on the Monday, because a lot of times we see gold being hammered or slammed overnight from Sunday to Monday, and it continues. And there's a story about the Chinese government implementing new VAT policies for gold. There's a lot of confusion about it because there's a lot of misinformation in the financial mainstream press in the West. People like Bloomberg and let's say CNBC and so on. So what about silver? Well, silver is doing quite well. I mean, relatively well. It's still not going gangbusters, but I think it's only a matter of time before we go back above 50. We're at 49.05, up about 40 cents. Spot silver, high's been 49.10, low has been 48.20. The stock market indices, we've got the Dow futures up 1/8%. S&P, same kind of gain. NASDAQ 100 future, that's up 0.25%. The currencies are virtually unchanged, really, versus the dollar. And in terms of the bond market, U.S. Treasuries, the 10-year is unchanged as well. It's at 4.10. So yeah, we've gotten back above 4%. The 30 years at 4.67. Why has that happened? I think it's because in the last FOMC meeting last week, the Fed tamped down a little bit the expectation of rate cuts, especially for December. So the market's kind of concerned that the Fed wants to try to control inflation a little more, and that they're concerned about inflation.
The signs are becoming impossible to ignore. From shifting global currencies to the cracks forming in the credit system, the transformation is already in motion. What once seemed distant is now unfolding in real time. Investors who understand these cycles know that when paper promises begin to lose power, tangible wealth rises to take its place. This isn't about fear, it's about awareness, preparation, and opportunity. We're standing at the edge of another great financial turning point, one that will reward patience, discipline, and real understanding. As history shows, the flow of money always returns to value, and those who see it early will lead the next chapter of this financial era. Share your thoughts on Mario Innecco analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.